If you don't know where the yield is, you are the yield. The average bank deposit rate in most developed countries is less than 1%. But in DeFi, the risk-free rate, or what we call the lending rate for stablecoins, is usually between 4 to 6%. And that usually mimics the Treasury bill or T-bill rate in the US. That is something that average investors will be able to get access to while paying minimal fees for getting those yields. As a business, you're always going to have a certain amount of cash reserves that are sitting in the bank, right? And in most cases, a lot of businesses, they don't actively utilize that capital. They might be able to hold now a stable coin, right, that is able to generate active yields between 8 to 15%. In 3 to 5 years' time, people won't even think about crypto or DeFi as whatever it is today. You will be using yield opportunities, or you might even be buying Pendle PT tokens without knowing it's a Pendle PT token behind the scenes.
Hello, welcome back to Odys podcast. My name is Aneta Samkov, and today I have a special guest because we're meeting at Consensus in Hong Kong, which is a cryptocurrency conference, one of the biggest in the world. And my guest is Wilbert Johann, a lead stablecoin and RWA ecosystem at Pendle. Thank you so much for coming, Wilbert.
Thanks for having me, Anita.
Awesome. So we're going to talk about like crypto's shift from like hype to income, because there is a lot of exciting things happening in the field. Can you tell us, like for executives and investors who might not be deep into crypto at this point, can you explain what Pendle does in like simple terms?
Yeah, I think before I go into what Pendle does, it might be interesting to break down crypto, because when most people hear about crypto, they think about prices, they think about Bitcoin and Ethereum. But there is a whole other side to crypto, or whole other side to blockchain, which is concerning the financial aspect of it, or more specifically DeFi. And with DeFi, we're talking about permissionless finance, right? So instead of traditional finance, where a lot of the rails today are facilitated by middlemen, banking institutions, in DeFi, a lot of this is automated by smart contract codes. So what smart contract codes are essentially is that they don't require any middleman to operate these platforms, whether it's a lending platform, or whether it's a yield platform, or whether it's a decentralized exchange. All of this is automated by code that is called on its own, which is why it's a smart contract code. Going into what Pendle is doing, we are a yield protocol. We're the largest interest rates market on chain in DeFi. And what we enable users to do is to trade yield and principal separately. Right? A lot of these assets that are on chain, whether they're yield-bearing stablecoins, liquid staking tokens, a lot of them have a yield aspect to it, right? But today, a lot of these yields are variable in nature. So you're not able to lock in fixed rates. But a lot of institutional investors and normal everyday investors like you and I prefer fixed rates for more predictable cash flow and outcome. With Pendle, essentially, you are able to simply trade one side or the other, either the principal tokens or the yield tokens. So essentially, when a yield-bearing asset is on Pendle, we split it into a principal token, which I was talking about earlier, PT, or yield token, what we call YT. Yes.
Okay, I see. So why should someone running a company care about decentralized finance at all?
Yeah, I think the benefit of decentralized finance, or DeFi in short, is the ability for assets to be composable. And let me just break down what that term means, right? So composable means being able to interact with different protocols on the blockchain. For example, I could use a stablecoin and deposit on a platform like Aave and Morpho. These are lending platforms. So you can deposit any asset that is supported and borrow, for example, a stablecoin. So perhaps I am depositing a stablecoin that is earning me 4 to 8% in yield annually. And I can borrow another stablecoin at maybe 1 to 2% borrow rate. So if you can see what happens there, right? I can earn a substantial amount of yield just from doing this activity in DeFi. And
without adding your capital, right?
Yes. So you're creating higher capital efficiency, firstly.
Exactly.
Right. And just to go one step before that, how does the 4 to 8% yield come about?
Yeah.
And there are different sources of yield, right? Where people are talking about real world assets today, which I think we'll go into a little bit more later.
Yes.
But the most common form of yield on chain comes from protocols incentivizing their users to be early adopters of the protocol.
Okay.
So a lot of these incentives are in the protocol's tokens, right? So the protocol's tokens, firstly, can be staked, for example. So what does staking mean? It means depositing it into the protocol for a certain period of time to earn rewards, right? In most cases, the rewards are in the form of yield, right? So the beauty of that is that once you deposit the token into the protocol, you get a receipt token, right? It's almost like a proof of deposit into that specific protocol. So when I'm depositing into Aave, I can actually take that receipt token and deposit to Aave, right? So now you see that there's a lot of interaction between the different DeFi protocols, or that's what we call composability in the space of DeFi.
That sounds like really good. But in traditional finance, risk is an important consideration, right? Can you tell us, how do you help investors think about crypto yields in those terms? Like, for example, how do you personally judge whether like a 15% yield is attractive or maybe dangerous?
Yeah, I generally think there are more yield opportunities in DeFi, firstly, because there are fewer participants, firstly. So there are more opportunities here, right? And also there is a certain learning curve to DeFi in the first place. It takes a while for an average investor who's already knowledgeable about finance to also learn how to use things like wallets to interact with decentralized protocols, right? How staking works, how do you earn yield, how do you do things like lending and borrowing. So it takes a little bit of a learning curve. So firstly, I think that the yield opportunities are higher in DeFi. So what is a good yield? I think that's very subjective to different investors, right? Some investors are simply looking to earn anything higher than what the bank gives, right? And the average bank deposit rate in most developed countries is less than 1%, right? But in DeFi, the risk-free rate, or what we call the lending rate for stablecoins, is usually between 4 to 6%. And that usually mimics the Treasury bill or T-bill rate in the US, right? So that is something that average investors will be able to get access to while paying minimal fees for getting those yields. Because otherwise, if you were to access those yield opportunities in traditional finance, you have to pay things like management fees. You have to pay things like performance fees for investing into a specific money market fund, for example. So that is something that DeFi offers, right? Access to yield opportunities while minimizing the cost involved, because a lot of this is operated, again, by permissionless smart contract code. So going back to the point about yield, 15%, is that a good number? I think it depends on the individual investor's risk appetite. And also you have to consider what is the risk that you're taking on in terms of the counterparty risk, right? Is this protocol trustable? What is the source of yield, right? Is this protocol generating yield from real world assets? For example, lending to businesses, private credit, right? Or are they generating yield from simply printing more of their own tokens and giving it out to their own users, which in most cases may not be very sustainable, right? Because if people start selling the tokens, the token price might go down substantially, and the yield may not even matter very much, right? So there has to be a balance of where the yield source, or what the yield source is, and where the yield comes from. And in most cases, if you don't know where the yield is, you are the yield as a user, right? So you have to get educated on what the source of yield is and balance that with the risk associated to determine if it's a good yield.
So how to actually do this? If someone holds like a real world asset tokens, how can I use Pendle to invest? What does Pendle enable me to do?
Yeah, that's a good question. So on Pendle, we support real world asset tokens mainly in the form of stable coins, right? So that's been the main kind of assets that have been on Pendle. So it depends on the protocol, because not every single token is supported on Pendle, right? Most of the yield tokens supported on Pendle already have some amount of traction. They have significant TVL. So TVL stands for total value locked, right? So in most cases, these are protocols with over 20 million in TVL, right? And you're able to take the stablecoin that is issued by these protocols, which are also then invested in perhaps real world assets for them to generate the yield on the stablecoin, right? Real world assets comprising of treasury bills in the US, perhaps money market funds, maybe private credit, lending to businesses. So there are different kind of yield sources, or even on-chain yield source, right? On-chain meaning you are generating yield from the DeFi space, right? Things like lending and borrowing. So they take the capital that people deposit for the stablecoin and they do yield generating activities on-chain, right? So that those are some of the ways where people generate yield. So when it comes to real world asset tokens or stablecoins that are supported on Pendle, right, you are able to bring it to Pendle, and it basically what Pendle does is we split the yield bearing token into PT, principal token, and YT, yield token.
Yeah.
Right. So you are now separating the yield portion from the principal.
Yeah.
And the benefit of doing that, as I was saying earlier at the start, is that you're able to choose one side or the other. And for more risk conservative investors, they may not want to speculate on the variable yield. Maybe this stablecoin could do anywhere between 10 to 15% yield, right? But perhaps I'm happy with locking in an 8% fixed rate, right? So PT allows you to lock in a fixed rate for a certain period of time on whatever asset. It could be the RWA real world asset token. It could be the yield bearing stablecoin.
Okay. And like non-stable coins also?
Yeah, we don't just support stable coins. We even have Ethereum, Bitcoin, and these are what we call liquid staking tokens or LSTs. So these are Ethereum and Bitcoin derivative tokens that generate an active yield from different protocols that have different ways of generating yield.
Awesome. So what are there any other opportunities for real world assets in DeFi?
Yeah, I think real world asset has been coming up a lot in DeFi, and there is a whole process to getting the real world asset on chain. Firstly, the issuance or the origination of the asset, right? The origination meaning, what is the source of the asset? Is it a money market fund? Is it a treasury bill? Is it private credit, for example? Right. Then you have the structuring of the asset. How is it packaged? What is the allocation of the asset? And then you have token issuance, which is then the representation of those real world assets in DeFi on chain, on the blockchain, right? And then you have the distribution aspect, which is integrating with different DeFi protocols like Pendle, like Uniswap, for example, or like Aave and Morpho. These are different decentralized apps that exist on the blockchain, which all serve different purposes. Pendle allows users to trade principal and yield separately. Aave allows users to lend and borrow against their assets. You also have Uniswap, which allows people to provide liquidity and trade on a decentralized platform as opposed to centralized exchanges.
There is lots of discussion about stablecoins becoming mainstream financial infrastructure. How does adding yield to stablecoins change the equation for businesses and long-term users?
That's a very good question. And I think from a business perspective, the interesting aspect will be thinking about treasury management. Right, because as a business, you're always going to have certain amount of cash reserves that are sitting in the bank, to pay for maybe short-term operational expenses, or sometimes it's not even being utilized, right? And in most cases, a lot of businesses, they don't actively utilize that capital, or in the event that they do, they're usually parking it in very safe haven assets, right? Something that's generating maybe a very minimal yield, but they're happy with that because it's very liquid. They can get that money anytime if they have to pay for any other expenses. But in DeFi, right, with stable coins, we started with obviously USDC and USDT. USDC issued by Circle, USDT issued by Tether, and these two stablecoins have dominated the space. Right, these are what I like to call stablecoin 1.0, where it is not yield bearing. Right, you're talking about the aspect of adding yield to stablecoins. So stablecoin 1.0, like USDC and USDT, they don't distribute yield to the holders. I can hold USDC and USDT in my wallet and I wouldn't be able to earn any yield from that. I have to actively be utilizing it in DeFi protocols like Uniswap, like Pendle, right? So by adding yield to stablecoins, I think it has opened up a whole new audience of, like in your case, you're talking about businesses who maybe want to do cash management strategies or treasury management, right? They might be able to hold now a stablecoin, right, that is able to generate active yields between 8 to 15%, right? So I think in the recent years, one of the most innovative stablecoins in the space is Athena. So Athena creates a tokenized strategy on basis. So maybe I should break that down a little bit more.
Yeah.
So Athena's strategy essentially is creating a delta neutral exposure. And delta neutral exposure basically just means that they're not exposed to the price changes. And they are doing this on Bitcoin and Ethereum, right? So for example, they're holding 10 Bitcoin, and on exchanges like Binance or whichever centralized exchanges, they're shorting an equal amount of Bitcoin on the perpetuals. So in crypto, there's this very unique thing called perpetuals, which trade 24/7, right? They're very similar to futures, but they are futures without an expiry, right? And the beauty with perpetuals is that there is a funding rate, meaning people who are buying Bitcoin perpetuals, and there's a very large volume traded for perpetuals, multiple times more than the spot market for most assets. If for perpetuals, people usually have to pay a specific fee. So people like Athena, they are holding the spot asset for Bitcoin. They're not paying any fee on that, but they're shorting a certain amount of Bitcoin to maintain a fixed exposure or delta neutral exposure. So that means if Bitcoin price goes up or down, they're not exposed to that price.
Yes. They secure it from either side.
Exactly. So why would they do that, right? Because with perpetuals, there is a fee involved, as I was telling you earlier. And in most cases, the funding rate is positive. So what that means is that if I'm buying Bitcoin perpetuals, I pay a fee. But if I'm short, I'm earning that fee. So so protocols like Athena, not just Athena, but many other delta neutral funds are actively shorting perpetuals while having a spot position. And by earning the fee from the funding rate, they're able to translate that into an active yield. So now you see it's a delta neutral exposure. So it's very similar to what that can be translated into like a delta neutral stablecoin, right? Or synthetic stablecoin. It is not backed one-to-one by US dollar or some other currency. But if you look at the way that this token moves, essentially it's like a stablecoin with a yield on it, right? So this is very interesting. And with yield-bearing stablecoins, Athena has obviously dominated the market, right? They grew to over 10 billion in market cap last year, right? Just in the supply of USDE alone. And that's been one of the major pulls on Pendle, because with SUSDE, the yield source is funding rate from perpetuals, but that yield is variable in nature. So the beauty of having it on Pendle is that you can fix the rate by buying the principal tokens or the PT version of SUSDE, which allows me to lock in instead of maybe 10 to 15%, I'm happy with 12, 13% for 3 months, right? So we're adding duration as well as a fixed rate.
So when people buy yield tokens on Pendle, what are they actually trying to do? Are they speculating, hedging future rates, or optimizing returns?
Yeah, that's a good question. I think so far I've been talking mainly on the PT side, which is getting a fixed rate, which is very easy to understand. With YT, it is indeed more of a speculative investment for investors that expect the future yield of a specific asset to go up in the future. And again, taking the example of Athena, SUSDE, which is the name of the stablecoin that they have on Pendle. If people expect the yield of SUSDE to go from maybe today it's like, let's say it's 7%, to 15% in the future, the way that I could get leverage exposure to that would be buying YT or yield tokens, right? So yield token gives the holder leverage exposure to the underlying assets change in yield. So maybe I should break that down a little bit more. So in usual, if you were to deploy into Athena directly, right, and the yield goes from 7 to 15%, you're getting 2 times the yield returns. Right. But if you're having a YT token and the yield goes from 7 to 14%, your value effectively doubles because you're only trading the yield aspect of that yield bearing token. So instead of just getting another 7 or 8% yield, my whole value has gone up twice because I'm only trading the yield portion of that yield bearing asset. So they're usually, in most cases, the YT buyers are optimistic that the yield of the underlying asset is going to rise in the future. So that's one part of it. The other part of why people buy YT or yield tokens is because a lot of protocols in DeFi, they issue points to token holders. So what are points? Points are a way of distributing ownership of tokens, of the project's tokens, right? Like Athena or any of this new stablecoin or DeFi projects. most of them are planning to issue a token or have already issued a token. And one way that they do that before the token is out and to incentivize early adopters is by giving out points. So if let's say you hold $1 of my ABC USD, right, I'm getting 10 points per day, right? And those amount of points eventually translates into an airdrop. What is an airdrop? So at the point of the token launch, when this project's launch tokens, they usually incentivize their early users with certain amount of tokens back to them, right? And the way it gets allocated is based on how much points they have. Right. So YT has been an interesting source of way to speculate on the value of these airdrops because it doesn't just give you leverage exposure to the underlying assets yield. It also gives you leverage exposure to the underlying protocol's points. So if you are really optimistic or you think that this protocol is going to do a very good airdrop, YTs will be the best way to do it. But there is a really interesting synergy between YT and PT, which are really both sides of a coin. When people buy YT on Pendle, it pushes up the implied rate or the fixed rate for the PT guys. So there is an interesting flywheel effect here. When people buy YT, whether because they speculate on future yields going up or they are trying to get leverage exposure to points, right? It pushes up the implied rates. And on the other side, we have PT buyers who may not be interested in speculating on future yields or interested in speculating on points. They simply want to lock in a fixed rate that is good enough for them, right? And so this is an interesting flywheel effect because when people buy PTs, and we have a lot of institutional users on Pendle today that are mainly on the PT side, they prefer just earning a fixed rate. When they buy PTs, it pushes the implied rate back down. So now the YTs are cheaper, right? So then as a prospective YT buyer, it might be easier to make a profit on that because the implied rate might be even lower than whatever the underlying assets rate is. For example, maybe Athena is doing 7% yield, right? And on Pendle, the implied rate is trading at 5%. So that means that as a YT holder, because as a YT holder, you receive the future cash flows, right? Depending on how often the protocol distributes it, whether on a daily basis, a weekly basis, you receive all these yields. Simply based on the yield that you receive because you bought the YT token at 5%, when the underlying asset is doing 7%, you would be making a profit on that. You don't even need to wait for the implied rate to go up on Pendle. Just based on the cash flows that you're receiving on YT, even without including the points or the potential of the implied yield going up, meaning the value of the YT going up, you are already making a profit.
I see.
Yeah.
So my question is now about the risk a little bit, because bringing products like this mainstream really depends on trust. And outside of a core crypto audience, people, may perceive it as more risky. Like you put up your money on one of those exchanges, it disappears, things happen, right? There are a lot of hacks. Like, what can you say about the risk and that kind of aspect?
Yeah, actually, that's the core problem that DeFi was trying to solve, right? So you mentioned exchanges. Exchanges actually are centralized platforms where it's operated by a team behind the scenes, right? So there is a certain level of trust involved as well. But with DeFi, the original vision is that everything is automated by code, right? So smart contract code, which I was talking about earlier. So you're not trusting whatever the person or the company is telling you. You're trusting the code.
The blockchain.
Right? You're trusting the code, which is available public to everyone, and anyone can audit the code to see if it actually is doing what it promises to do. Right. That being said, I think DeFi protocols today are not entirely automated. There are still some segments where it involves some level of strategy, or decision making from a multi-party consortium. Right. It could be comprising multiple people in the team. But I would say it's largely automated, especially for the blue chip protocols. Pendle being one, Aave, Morpho that I was talking about earlier, Uniswap. A lot of this core functionalities, lending, borrowing, swapping on Uniswap, or trading yield, PT and YT tokens on Pendle. That is a function that is automated by code. Meaning if I was to deposit X amount of dollars into Pendle, for example, trying to buy PTs, I'm guaranteed to get the PT tokens because the transaction will fail otherwise. If that doesn't happen, right? So that is something that DeFi is trying to solve originally, which is to minimize the trust. But then now you have an additional layer of risk involved, which is smart contract risk.
Okay.
So what does that mean, right? So the potential for certain smart contracts to be exploited or hacked, right? Because now you're not trusting in the human, you're trusting in the code. But code is also not fail-proof, right? Because hackers are, always exploring new ways to exploit code bases, right?
Exactly.
So I would say that for Pendle specifically, security is a top priority, as I'm sure it is the main security priority for most other blue chip protocols in the space, right? Because we're securing a large amount of assets. But largely apart from that, it's everything is automated by code.
Okay, I see. Also, so looking into the future, how do you envision the world of crypto yields in 5 years? I know it's a very long horizon, but I'm just curious.
Yeah, so I was having a conversation earlier at the main consensus event, and I think the consensus, unintended, is that in 3 to 5 years' time, people won't even think about crypto or DeFi as whatever it is today. You will be using yield opportunities, or you might even be buying Pendle PT tokens without knowing it's a Pendle PT token behind the scenes.
Okay.
Right? So we are talking about abstraction, meaning I was to buy like a fixed rate opportunity from a neobank, which behind the scenes might be deploying into a Pendle PT fixed rate opportunity. But you're not sure what's happening behind the scenes, right? You just understand that it's some kind of DeFi yield. So that is where the future is headed, abstraction. And I think in order for us to onboard more users into the space and to grow DeFi or crypto as it is today, there has to be more abstraction, more seamless UX and UIs, right, that allow everyday retail investors to be able to access DeFi protocols like Pendle.
Awesome. This sounds really good. So thank you so much, Wilbert, for sharing so many of such timely insights from crypto niche. And if you enjoyed this episode and want to learn more, follow Wilbert on LinkedIn and don't hesitate to message him over there or in the Telegram groups, and subscribe to our podcast on the YouTube channel. Thank you.
Thank you.